Hey guys, welcome to Beast Investing. My name is Luca. Hope you guys are having a great day as usual. Today we will be having our course number 4, which is how to read financial statements. Now remember, these courses are meant to bring you from a brand new entry-level investor all the way to be able to putting in your first dollars into the market. Alright, in this video we will be focusing on how to read the income statement as well as the cash flow statement. So quick overview of what we will be learning is what are financial statements. We're also going to talk about 2 of the main financial statements. There's 3 main ones. We're going to talk about 2 of them, the income statement and the cash flow statement. By the end of this video, or this one and the next one, which will be about the balance sheet, you guys are going to be accountants or close to it. First off, what is an income statement? An income statement is, or financial statements in general, are statements that the company publishes every quarter or year, but most companies in the US anyways have to report it every quarter. What these companies do, they say how they've done numbers wise in the past 3 months. So every 3 months they release earnings, we call it. They release 3 main statements as well as a 10Q if it's a quarterly report and a 10K if it's an annual report. So 10Q, and so it comes with the financial statements, but also has a lot of wording. They give their guidance for the future. They say what lawsuits maybe they've had. They say what new competition looks like, how their user growth is, or whatever their case may be depending on the business. Here we have our first statement, which is the income statement. This is what I explained in the course number 1, where it was revenue minus expenses equals net income. This is a screenshot I took from Facebook. So this is Facebook's income statement. So at the top over here, we have total revenue. This is our revenue, obviously. In this case, in 2020, it was $85,965,000,000. That was their revenue. Remember, top line. This is the first dollars that came into the company. After that, we have a lot of expenses here. I will be explaining further what these expenses are and how they affect the business, because they're all a bit different. But all you have to know is that revenue minus all these expenses, which leads you finally to our magic word, which is net income. Net income in Facebook's case is $29 billion and 146 million. So we have, in short, revenue minus expenses equals profit. As you can see here, revenue minus all of these things are pretty much expenses. And you have our net income, which is our profit number. What we also have is what's called shares outstanding. This is very overlooked in the beginner novice investing world. Yet this has a huge play in your returns as a shareholder. Remember what we said shares outstanding were. Facebook company is a pie. This pie is divided in a lot of pieces. Depending on how many shares outstanding and if the number of shares outstanding is getting bigger or smaller, this affects what you own as profit. If Facebook decides to issue more shares, that means that my piece becomes less valuable because I'm entitled to less of that profit. So as I said, there were a lot of expenses. Now we will be looking exactly what those main different expenses are. First off, we have cost of revenue. Cost of revenue pretty much means how much it costs me to directly manufacture a good or provide a service. In this case, it could be materials, like directly putting it into the product. It could be manufacturing, transport, labor. So it's all the things that relate directly to the product. And if we go look back, this is what we find. So it's the cost of revenue that leads us to the gross profit. So this is the profit after I put it in to the product. As you can see with Facebook has a really low cost of revenue. That's because first of all, it's a tech company and it's more software-based. Software has much less input into the cost of making the service. In this case, Facebook is a service. As opposed to, let's say, a car where I have to pump in all the metal, I have to labor. There's a lot of much more expenses than Facebook would have to originally create the product. We have research and development, often called R&D. What this means, it's the expense to make new products, innovation, or improvements to the existing products I have. This type of expense is usually a bit better than the others because this means that the company is reinvesting in itself, kind of. This is one of the ways we could see if a company is trying to invent new things. I'm willing to bet Tesla, for example, has much more R&D, so research and development cost, than let's say a company like Kellogg's or something that sells cereal. So I'm sure that they have much more expensive and they're trying to grow and innovate much more than the others. And on the sheet where we can see that is right here, research and development. We see there's $18 billion spent on that. So what we have here is revenue minus the cost of revenue which gives us gross profit. And from the gross profit, we start taking out other expenses. And we're going to talk about what these rest are. For now, what we have seen is the R&D, which is 18 billion. So we have 69 left. Now we go to 18 billion. And now we have our next expense, which is selling, general, and administrative. What this is, it is everything that you consider the overhead of the company. Overhead is things like rent, equipment, depreciation. We will be talking about depreciation, but it's all things that every month we're gonna have those same expenses type thing. Or it is the maintenance on their buildings, maintenance on their equipment. It's all these things that are constant costs. Over here, we see it again. So it's right under R&D. It's selling, general, administrative. Facebook spent another $18 billion on that. Now, what's also cool to see is that now we have what's called total operating expenses. What this means, this is the total profit the company would make before taxes and before interest if they have debt. This is what some people look at. It's called EBIT. So it's earnings before interest and taxes. Honestly, I find it kind of stupid to look at EBIT because the government is taking the money. You don't own that, let's say in this case, $32 billion of profit. The government took a chunk and interest took a chunk. What we actually own is net income, which is in Facebook's case, not that much more. And as I mentioned, our last expense is taxes and interest. So that's all the money paid out to either the government or to debtors. And here we have a lot of the examples. So interest expense, Facebook has zero long-term debt, so they don't have a number here, but they have paid a little bit in the past. Then we have income tax expense, which is 4 billion right here. And then we have finally our net income. So remember, we have revenue minus the direct cost for the products, which give us the gross profit. Then we have R&D, which is innovation in the business. And then we have overhead. And then finally, we have interest and taxes. So that's how we get from revenue all the way to net income. Now, depending on what these numbers actually say, it tells a story about a company. And that's what's beautiful about financial statements. In Yahoo Finance's case, we go back 1, 2, 3 years. I have a software that goes back 10 years and we'll be able to go back even further afterwards. But it gives a story. So for example, what we will see here is that from 2017 to 2018, they grew 15 billion, which is very, very crazy growth. It's around 35% or something. Then we see another big jump of growth, another big jump. So we see that the company is growing revenues. Now let's see, for example, how fast their R&D is growing from 7 billion to 18 billion. So way more than doubled. It's kind of in line with revenue. So that makes sense. So that means that Facebook is not slowing down on innovation, which again tells you something about the company. Selling and administrative, kind of same thing. It's keeping pace with the company. I'm not too worried about that. It's like, let's say if revenue tripled, but then selling, general, administrative quintupled or even more, then you start asking, okay, why is this happening? You know, this hurts margins. Remember, margins is how much of the percentage of revenues goes all the way to the profit. So we want this margin to be getting bigger. That way more of this profit grows even with flat revenue. So if I have flat revenue and my profit margin grows, that means my profit is growing. All right, next we will be talking about depreciation and amortization. What this is, it is lowering the value of an asset over its useful life. All right, what this means is that if I have a machine that is only good for 5 years and then I have to get rid of it, that means I could depreciate this machine in 5 years time. So at first I start with a machine worth $1,000. After 5 years, I finish with a machine at $0. And also what's important to note is that it is a non-cash expense. I'm technically not paying every year for the machine, but I may eventually have to have expenses incurred to actually replace the machine. So first off, how does this work? We will have a hypothetical situation. I'll show you why people do it and what value it brings to a company to have depreciation. So first off, let's assume I make $100,000 per year profit in my business. Let's also assume that I own a factory worth $500,000. This factory will need to be replaced after 30 years. So I'm saying, and usually real estate is actually very depreciated asset. Real estate and equipment are the main ones to my knowledge. Let's say I have a factory and it's only good for 30 years. After that, it's gonna be worth $0. I'm gonna have to buy a completely new factory. This means that the building is lowering in value by $16,666 per year. How I got this math is I used $500,000, which is the worth of the factory, and I divided it by 30 years. It is not a linear depreciation, but I'm just gonna assume it for simplicity's sake. Usually it's it's a exponential graph. So you depreciate less and less technically as time goes on. But we're gonna assume that it's a flat rate of 16,666 a year. What the advantage is of this is that a company can write it off against its profit. So remember, the profit in this case was $100,000. Then I could write it off as an expense, even though I didn't pay to replace the building already. It's a non-cash expense. This is what's important to remember. So I will pay taxes on only $83,334. So that's $100,000, which is my profit, minus depreciation expense, equals that. So a company gets to save money every year, and eventually, yes, they'll have to dish out the money to buy a new factory. But they've been saving it for 30 years. They could grow the business with that money in 30 years. So that's why companies do it. Another quick note, amortization is kind of the same thing, except this involves usually like mental kind of property. So patents especially, those depreciate, except we call it amortization. So it's very similar concepts where a patent has a useful life, which let's say I have a patent for a medical drug for 10 years. Over that 10 years, I could write off the expenses of that drug, or I could write off the asset of that drug, and it will be worth zero after 10 years. Even though technically it's not zero, there's always a value even afterwards, but we're not going to get into that for now. Next, we will be studying what the cash flow statement is. Cash flow, in short, is cash in the business minus cash out. So all the dollars that came into the business and all the dollars that came out. It's a much simpler kind of financial statement to understand. So the main difference between cash flow statement and net income is that in the cash flow statement, you're adding back in all the non-cash expenses. This includes, as we just saw, depreciation, amortization. It also adds back in change in working capital. What working capital is, it just means your current assets, which is usually cash, minus your current liabilities. So the debt you owe in the next year. All you have to know is that you do cash minus current debt equals an amount. And then you do the same thing for last year and you compare the both, and that's going to be the difference. And that's going to be added into the cash flow statement. I know this is confusing. It's not the most important thing. We will be covering it further in the courses too. And also what you add back on is other adjustments such as stock-based compensation. So when a CEO performs well, the company rewards him with stock, or let's say, or stock options. This is technically a non-cash expense, so we don't consider it in the cash flow statement. And the main formula for free cash flow is equal to cash from operating activities minus capital expenditures. We'll be seeing what those mean. So first off, right here we have the cash flow statement of Facebook. So again, it's the same thing as the income statement, same company. What is capital expenditures? It's divided in two main sections. You have what we call growth CapEx and you have maintenance CapEx. For the growth CapEx, what this means, it's the purchase of new assets intended to grow the company's profitability and growth of earnings. What this means is that this is the amount of money from the CapEx that the company is investing in itself, kind of like the R&D. It's all connected. It's after all, they're all the same financial statements of the same company, right? So they're all connected. The next one is the maintenance CapEx. Now, this is the cash that's necessary to keep the business running and to continue current operations. This includes things such as repairs, painting, new flooring. It also includes wages. It includes all these things that the business needs to stay the same. So let's say if the company did not want to grow a cent more, they would have to keep on this maintenance expense. So a growth CapEx could be stopped technically. The company could completely stop growth CapEx, but they cannot stop maintenance CapEx without it affecting earnings. This is important to know because it tells you a story about the company. So if the company is really growing, is throwing a lot of money at growth CapEx, eventually if the company wants to slow down a bit growth and start growing its earnings, they could start lowering growth CapEx. As opposed to a company that has zero growth CapEx, that means the company will never be able to increase margins. Technically, that's what it means. So as you can see here, what we have is the net income. Now we're gonna go through the statement. The net income, remember, that's from the income statement. So we take that and then we add back in depreciation. We add back in stock-based compensation, working capital, the change in working capital, and we add in a couple of other things. Now what this leaves us is our famous cash provided by operating activities. Remember our little formula? Cash flow from operating activities. So that's what we have right here. which is $38 billion in Facebook's case. Now, what we have for CapEx is written down here. Most companies don't declare straight up how much they spend on CapEx. You have to dig in, and it's kind of easier to go look at R&D. So right here, we see that the CapEx is $15 billion, which leaves Facebook with a $23 billion free cash flow. I will explain why exactly free cash flow is the most important in my opinion. So here we go. We're going to see what this free cash flow number means to us as shareholders. What a company can do with this free cash flow is, one, they could pay dividends. So remember, this is when the company sends you cash for owning their shares for usually a longer amount of time. Number two is they could buy back their own stock. Remember, I have a pie. If there's less pieces in the pie, my piece is worth more. Number three, they could pay down their debt. Now, this is usually a good thing. It lowers your interest expense, or every year I'm gonna have to pay less in interest, which means more in profit for me as a shareholder. So this is very important to me too. And finally, you could save up that free cash flow, store it as cash in your company, and you could eventually make acquisitions with it. So you could buy up smaller companies than you and have growth like that. So this is why it's super important, this free cash flow number. It's kind of the same, it's profit. That's what free cash flow means, it's profit, except it's calculated a little bit different than net income. The reason why this free cash flow number is the most important, apart from all the reasons we mentioned, is that this is what I use to calculate the intrinsic value of a company. Remember, we said the intrinsic value is the earnings of the company multiplied by a PE, or in this case, it would be price to free cash flow, which is just a multiplier, and that is my amount of intrinsic value I give to the business. In recap, guys, we have learned what the income statement was, which is, remember, revenue minus expenses equals profit. We learned what depreciation is and amortization, which is when a piece of equipment, for example, starts off at $1,000. After 5 years, we're saying it's gonna be $0. So technically that's an expense every year for the next 5 years. And that is present on the income statement, remember, not the cash flow statement. We also learned about the cash flow statement and how that is what it is, cash in minus cash out. So all the money that goes in the business minus all the money that comes out, cash. And finally, we learned also what the uses were of cash flow, of free cash flow. So this is dividends, share buybacks, pay down debt, mergers and acquisitions, as well as how I find the intrinsic value of a company. So stay tuned, guys. Next video will be about balance sheet. Don't forget to like and subscribe. It was a pleasure giving you guys a course today. I hope you guys have a great day.